This video is going to cover the topic of trading on margin. And in particular, we're going to cover margin calculations when you are buying shares on margin. So first of all, what does it mean to trade on margin? What are we talking about here? So buying on margin is when you borrow money from your broker. Let's say I have an account with Charles Schwab. And then I go and I ask Schwab, say, hey, can I borrow, say, $5,000 in order to buy stock? So that's called buying on margin. You are borrowing money from your broker in order to trade stock. Okay? Now, what we're going to see here is that when you do that, the broker has a lot of interest in making sure that you don't lose a lot of money. So they go through a number of calculations and they make sure that basically you can pay them back not only that $5,000 plus interest. So in doing that, we're going to see there are a number of definitions that come up, and there are different things that they track if you buy on margin. So let's jump right into these. So here are some definitions that we're going to run into. The first one is we're going to talk about so-called margin or account margin, and that you can think of as the net worth or account equity of the investor's account. Now we can think of, if I'm the one who has the account at Schwab, then I'm the investor. So when I talk about account margin, it's basically the net worth of my account. How much is it worth? All right. And then we're going to see regulations are in terms of something called the percent margin or the margin level of my account. Now that will be defined as the ratio of the net worth of my account to the market value of securities in the account. Okay. And here, what do we mean by the market value of the securities in my account? Take any shares in my account, take the number of shares and multiply it by the price per share. We're going to see examples of this. So in words, some of this is hard to follow. Soon we'll be working through an example and you'll see exactly what these things mean. All right, final thing to keep in mind as we go through the examples, many of the regulations are in terms of this margin level. You can think of the margin level as the percentage of the securities market value that you actually own. Okay, so that's a good way to think of it. Again, we'll get examples in a minute. All right, let's talk about what actually happens if I buy some shares on margin. Okay, so there are a couple of things that will happen. The first is that there's a so-called initial margin requirement. I'm going to call that IMR. And this is when the investor initiates the position. That is, I go when I buy shares, maybe of Apple, and I want to buy on margin, which means I want to use money borrowed from the broker. I have to meet what's known as the initial margin requirement. This is actually set by the Federal Reserve under Regulation T. That's not that important other than some of the time in your broker you will see a line that says Reg T margin, and that's where it's coming from. It's currently 50% for stocks. What does that mean? That means if I purchase shares of stock, let's say I purchase 10,000 worth of Apple, I have to put up at least 50% of that. That's what that means. So that is the initial margin requirement. That is the percentage that I have to pay for of those shares. I can only borrow up to 50%. Okay? So IMR, that's the minimum percent margin of the account when I first enter into a trade. And again, 1 minus that is the maximum percentage that you can borrow from your broker. Right now it's symmetric. I have to put up at least 50%, meaning I can borrow a total of 50%. Okay, that's when I start the trade. Let's imagine I buy 10,000 worth of Apple. I used 5,000 of my own money, and I used 5,000 in a loan from the broker. Okay. Then during the course of the trade, my margin amount might change, okay? And that there is a so-called maintenance margin requirement. I'm going to call that MMR, or maintenance margin requirement. This is a level that the margin percent must stay above during the entire course of the trade. So remember, the margin is the amount that I own. So let's say I purchase shares of Apple, I put in 10,000, and then I borrowed 5,000 from the broker. Let's say Apple begins to drop in price. Let's say it goes from 10,000 down to 8,000. Now I still owe the broker 5,000, probably plus interest, but I still owe the broker $5,000. So the amount that I actually own now, sort of my net worth in Apple, is only 3,000. total of 8,000. Okay, so that means my margin level has gone down. Okay, so the broker is going to track that. Why? Because if it goes down too much, the broker always wants to get their money back. Okay, so they don't want to see your margin level go too low. So they're going to set a maintenance margin requirement. Okay, many exchanges mandate that it's 25%. Many brokers are going to require a higher percentage. All right, what happens if I bought Apple, Apple starts going down, and my margin level hits that maintenance margin level? Okay, then what's going to happen is I'm going to receive what's known as a margin call. What is a margin call? It's actually a call or a notification from your broker saying, hey, you're losing too much money. We loaned you $5,000. We want to make sure that we can get our money back. And they'll usually tell you one of two things. Either add additional money to your account, or we're going to sell your shares in Apple and we're going to take our money back. Okay, and that's called a margin call. All right, so those are the mechanisms that go on when you trade on margin. And you can see that it's there's an attempt to make it safe. The broker is, if they loan you money, they're always going to be monitoring your margin level. And if you go below that maintenance margin requirement, then what are they going to do? They're going to sell out your shares, and they're going to take their money back, so that, plus interest, so that they know that that is a safe loan. All right, let's walk through some of these calculations. Best way to understand this is just to go through the numbers. So I'm going to jump right into an example here, and I'll show you a nice way to structure these problems so that it's pretty easy to track through, you know, how to calculate margin percents and things like that. Okay, so this is going to be a running example. X Corporation, let's say their stock price is $70 per share. You'd like to purchase 1,000 shares. 1,000 times 70, that's going to cost you $70,000. However, you only have 35,000 in your account. Okay, so to buy on margin, what do you have to do? You have to borrow the other 35,000 from your broker. That's the margin loan. All right. We're going to walk through some questions related to this. First one, what is your initial percent margin or your initial margin level? Now maybe this one you can do in your head. You should try to look at this, and hopefully the answer will jump to mind. It's, well, how your margin level is how much money did you put up in this trade? Well, you put up half of the money, so it's going to be 50%. However, I'm going to do it in a very structured way, and that's going to help us when we go to further parts of this problem. So here's my very structured way of looking at these. We're going to do a little balance sheet for our account. Okay, so we're going to do a balance sheet. And if you remember from your accounting, not that I'm great at accounting, but a balance sheet looks like this. On one side, I've got assets, so that's right over here. And those are all the things, you know, of value sitting in my account. And the other side, what do I have? I have liabilities. That's what I owe to somebody. And then normally down here, I will have what's known as equity. But instead of us calling it equity, we're going to call it account margin. Okay, and you can think of that as your net account value or your account equity, if you will. So if you like, every time we say margin or account margin, think of account equity. And what is the basic formula? Basic formula here is equity equals what? Assets minus liabilities. So for us, it will be margin equals assets minus liabilities. Now, as we set this up, here's what the account looks like. On the asset side, I've purchased 1,000 shares of stock X. It's worth $70 per share. So that's sitting in my account. So those are the assets. All right. Now I go to the other side of the balance sheet. Liabilities. What do I owe? Okay, I owe $35,000 to the broker. So that's my liabilities. And then margin equals assets minus liabilities. We're always going to use this equation. Margin equals assets minus liabilities. The assets were what? It were those shares. That's worth $70,000. Minus I owe $35,000 to the broker. So my account margin is $35,000. So that's the first calculation we will always do. And then after that, we will calculate a margin percent. So here, it needs to be the initial margin requirement, but this is our margin percent. And how do we calculate margin percent? It's always going to be exactly the same formula. We're going to take the account margin. Where does the account margin come from? Right there. right? It's that assets minus liabilities. Account margin, and we're going to divide it by the market value of securities associated with the account. What are the securities associated with the account? That's the 1,000 shares of stock X. How much are those worth right now? 70,000. So my account margin is 35,000. The market value of securities is 70,000. I take that ratio and I get 50%. Okay, so that was sort of a long way of something that was obvious. I put up half of the money, so my margin percent was 50%. Let's move on to the next step here. Assume that the stock price falls to $65 in 1 year. Okay, so I'm losing money. I bought it at 70, it's down to 65. The yearly margin interest rate is 5%. So in addition to losing money on the stock, the broker says, hey, you owe me 5% on the margin loan, that 35,000. Now, what is your percent margin? And if you sell out of that, what is your rate of return? What is the investor's rate of return? So let's go through these calculations. Once again, the best way to do this is to track along in a balance sheet. So on assets, what do I have? I still have those 1,000 shares of stock X sitting in my account. Now they're only worth $65 per share for a total of 65,000. What do I owe to the broker? 35,000, right? That's what I borrowed from the broker, plus 5% interest. So now I owe a total of 36,750. All right. What do I do next? Always going to do these steps. I'm going to calculate the account margin. How do I calculate account margin? Assets minus liabilities. The assets here are worth 65,000. The liabilities, that's what I owe to the broker, 36,750. I take that difference. My account margin is now 28,250. All right. And then what is it asking me for? It's asking me for actually two things. The first one is, what is my percent margin? So what's my margin percent? Always the same formula. Take account margin. We just calculated that. That's 28,250. Divide it by the market value of the securities. How much are the securities worth? 65,000 now. That was right here. I take that ratio and what do I get? 43.46%. So now my margin percent is 43.46%. So that was the first thing it asked for. The second thing it asked for was, what was the investor, and I'm the investor here, what was the investor's rate of return? How do I calculate that? When I think about rate of return, I think about my net account value and how that has changed over time. Okay, so my net account value, let's go back to part A. My net account value, that is my account margin, it started at 35,000. That's essentially how much it was worth in. Now, my net account value, or my account margin, is only worth 28,000. So I'm going to use those numbers to calculate that rate of return. So let's do that. So my investor rate of return is the change in account margin divided by the initial account margin. The change in account margin, I lost money here. So I'm only at 28,250 and I started at 35,000. So I lost money there, not quite 7,000, a little less. And I started at 35,000. That represents a loss of 19.29%. That would be my investor's rate of return. Okay, let's continue on. If maintenance margin is 40%, at what price will you receive a margin call? Let's remember what maintenance margin is. When you're trading, if your margin percent hits maintenance margin, then the broker says, uh-oh, I'm worried. I loaned you money. You're losing money. I want to make sure that I'm going to get my money back. That's when you would get a margin call. Okay, so that's an important level. So here's the question. If the broker has set a maintenance margin of 40%, what's going to be the key price at which, if the stock drops to that I end up getting a margin call? All right. So here's how we do that. In this case, what I don't know is I don't know that price. So that's going to be my variable P. And I want to find the price P that corresponds to a margin percent of 40%. So let's do that. Once again, I'm going to go to my balance sheet. On the asset side, I've got the 1,000 shares of stock. Now, I don't know the price, okay? So I'm going to put the price as P. That's what I need to solve for. All right. Liabilities, what do I owe? I owe that $35,000 plus the 5% to the broker. So what does that mean my account margin is? My account margin is what? Assets minus liabilities. Here the assets are what? 1,000 shares at a price of P per share. Again, I don't know P. I'm going to have to solve for that. Minus the loan that I owe to the broker. So that's my account margin. Now we move to the next step. This is the margin percent. And here, I want to know when that margin percent hits the maintenance margin requirement. That's the 40%. How do I calculate margin percent? I take account margin. In this case, it's the formula right here. 1,000p minus 36,750. I divide that by the market value of the securities. How much are the securities worth? Again, I don't know, but I have 1,000 shares and it's P per share. And I want to know when this ratio equals 40%, when it equals that maintenance margin. Now, once I get to this point, it's algebra. I need to remember how to solve an equation like this. I'm going to leave that to you, but you would solve this equation for P, and you're going to get a price of $61.25. So what does this mean? I bought at 70. If the price hits $61.25, the broker is going to contact me and say, hey, we've got a problem. You hit the maintenance margin requirement, and you need to do something about it. So let's go to the last part of this, and let's see what they might require. So assume you receive a margin call. So if I received a margin call, I know the price hit $61.25. Okay, so let's put that up there, because I hit that maintenance margin requirement. So I get the margin call, and they say the following: you need to increase your margin to the initial margin requirement. What was the initial margin requirement? It was 50%. So I need to bring my margin percent back up to 50%. How much money do you have to add to the account? All right, once again, we're going to tackle this exactly the same way. We're going to use a little balance sheet. So what do I have? I have 1,000 shares of stock X. I know because I got the margin call that they're sitting at $61.25 per share. In addition, they want me to add money to my account. So I'm going to have to drop cash into my account. I'm going to call that C, as those are going to be assets sitting in my account. All right, now I go to the other side. I go to the liabilities. I still owe this loan to the broker. I owe the $35,000 plus the 5%. All right, so putting these together, I can calculate my account margin. Account margin is what? Assets minus liabilities. So margin is on the asset side, it's both of these. It's the shares, right? And the cash minus, and then liabilities, that's the loan. So when I put all those together, the shares are worth $61,250. The cash is C, that's what I don't know. And I owe $36,750 to the broker. So that's going to be my margin, my account margin. And then what do they want me to do? They want me to bring my margin percent back up to the initial margin requirement, which is what? 50%. So I calculate that margin percent. Margin percent is what? It's account margin, right, which I calculated there. It's the $61,250 plus C minus the amount that I owe to the broker. Divide by the market value of the securities. These are the securities right here. How much are they worth? $61,250. This ratio needs to be 50%. So here I can solve for C. If I solve for C, I find out that I'm going to need to add $6,125 to the account in order to be margin compliant. Okay? Otherwise, what will they do? They would probably just sell my shares, and they're going to take back their $35,000 plus the 5%, and they're going to say, you're done, okay, because you were losing money. All right. So this ran through a number of the scenarios and calculations that go along with buying on margin. Before we finish off this section here, let's talk about why would somebody buy on margin? Why would you do that? So why would somebody buy on margin? Because you can increase your rate of return. Or a better word to use here was that you will generally magnify your rate of return. What does that mean? If the stock goes up and you bought it on margin, generally you make more money. If it goes down, you lose more money. It just magnifies returns. It makes things riskier. Let's do a little sort of back of the envelope calculation just to show you this. Let's consider the previous example. Assume the stock increases 10% from $70 up to $77. What would be your rate of return without margin and with 50% margin? Just a simple calculation here. No margin, let's do it on a per share basis. What would my rate of return be? Well, I bought the shares at 70, they went up to 77, so I made what? $7 per share. And how much did I have to pay for the shares? $70. So that's a rate of return of 10%. Okay, nothing surprising there. On the other hand, what if I bought on 50% margin? And here I'm going to ignore the interest on that margin loan. Now you shouldn't do that, but just for back of the envelope ideas here, let's ignore that. So now let's calculate my rate of return. So again, I bought the shares for $70. They went up to 77. So that's a profit of $7. But how much money did I actually use of my own money? I only used half of the money. The other half was borrowed from the broker. So that means I made $7 on an investment of only 35. That's a 20% return. I just doubled the return of the 10%. Okay? So what buying on margin does is it magnifies these returns. If I had lost money, I would have lost a lot more on margin. So it just magnifies those. Now, in general, what I should do is I should also subtract off the interest, right, on the margin loan. And so that will change this. But the general idea here is that by trading on margin, by borrowing money from your broker, you can really magnify returns. That's great if you're right, because you make a ton of money. It's really bad if you're wrong, because you can also lose a ton of money. So it makes things riskier.